Hello. Today's video presentation is on Chapter 8, Risk and Return. We're using a PowerPoint slide presentation starting with slide 33 to talk about beta. Beta is part of the discussion on risk and return. Beta is a fundamental concept to a good bit of finance. Beta measures a stock market risk. So we'll look at a specific security in relation to overall stock market risk, and we'll give it a beta as a result of that. Okay? So the beta applies to a portfolio, to a specific stock, to the market, and it's a numerical measure of risk. An average beta is 1. So the stock market beta is 1. So we have a tendency to use this as our benchmark whenever we talk about beta or the stock market. If you have a high-risk stock, generally it's going to have a beta that's greater than 1. If you have a low-risk stock, generally it's going to have a beta that's less than 1. So this is our benchmark.
Asset risk
Okay?
premium here.
When we talk about a stock's risk relative to the market, the market should include all investable assets. However, in practice, we generally use the S&P 500 as the benchmark for the market.
And the required return.
So in the opening slide, it defines beta as measures a stock market's risk, shows a stock's volatility relative to the stock market. Secondly, it indicates how risky a stock is if the stock is held in a well-diversified portfolio. So beta measures stock market risk. It does not measure idiosyncratic risk or diversifiable risk. We assume investors will not earn return for any idiosyncratic risk. If we can diversify risk away, we have a responsibility to do so. The intelligent investor will not will not have diversifiable risk in their portfolio.
The third investment is Treasury bills. And Treasury bills have a beta of 0, no risk, and that's 20% of our portfolio.
Comments on beta. So these just give us a few benchmarks here, right? So a beta of 1, it's the same as the average stock, the same as the S&P 500. A beta greater than 1, the security is riskier than average. So for example, I think the text uses a high-tech company as representing a high-risk company. Additionally, maybe you'll talk about a biotech company as high risk, or maybe deep-sea oil drilling as a high risk.
Question 4, what is the expected
so those are companies or securities that have a beta greater than 1. The third point is a beta less than 1. Standard examples of lower risk companies would include a utility company, or utility stock, or a consumer goods stock. Most stocks have betas that range between 0.5 and 1.5.
Total value of the portfolio is 21,000. Okay, 21,200.
Can the beta of a security be negative? Yes, it's possible, although, right, look at the second point, or the first point, if the correlation between stock I and the market is negative, right, then the beta can be negative. So if this correlation coefficient is negative, then the beta can be negative. This is highly unlikely. Most stocks have a positive beta. So for example, we could talk about gold. Gold as a stock company that mines gold, or gold as a commodity. In both cases, they will have a low or a negative beta, depending on exactly how their returns correlate to the market. That's why we saw a run-up in gold prices during the recession. Because it's counter-cyclical, people have a tendency to flee to that when the market's return is going to be low or negative.
We simply can take
I think your book uses a collections company, 50% stock, or a company that collects average of the two, 14.5.
And that's 25% of the time, so standard 25% times 14.5.
Calculating betas.
And that'll give us the component.
So we're going to look at a well-diversified investor. They're primarily concerned with how a stock is expected to move relative to the future in the market in the future. No one has a crystal ball, so we have a tendency to use historical data.
Together, we get to 10.
On the next slide, we're going to estimate beta by running a regression.
And that gives
I think visually it's very clear. Mathematically,
some of the two
it's not quite so easy, but I think you should be okay. The slope of the regression line is defined as the beta for the security.
And you could say, well, 25% of the time it's going to return 16.
So here's our picture, and this calculates the beta. Here's our regression line. Here's the slope of the regression line, 1.44. So in this example, that's our beta. 1.44 is the slope of this red line. The slope of the red line is the beta. Notice on the horizontal axis we have the return of the market. On the vertical axis we have the return on stock I. Okay, so we're comparing how does the return on stock I vary in comparison to the stock market. Let's look at year 1, positive 15 and 18. That's this point right here.
Okay, so you can see it's almost on the line, but not exactly. We have questions over this.
All right.
Questions over this problem. We have a -5 and a -10. Okay. So year 2 is captured with this point here, and then year 3 is 12 and 16. That's captured right here. So you can see this red line should basically go through the middle of all those points. I'm not sure who did this regression. They probably made a little bit of an error, but that's okay. Visually, we still understand that this line is a good estimate of the line that goes through those 3 points. You can see that since this point is higher and this one is lower, this red line should have been cocked down a little bit on the top and a little up on the bottom, and we would have gotten a better line. Regardless, 1.44 is what it says is the beta of this line, and this is one strategy for computing beta. This slide gives us 3 illustrations of beta for 3 types of companies. You'll notice, let's start at the top. This is a high-risk company. It's a high-risk, high-tech, and the beta for this is 1.32, a kind of a steepward upward sloping line. The beta on Treasury bills here is 0. Treasury bills are assumed to be no risk and have no correlation to stock market returns. Then we have the collections company. As I suggested, this is our countercyclical security, and in this case we have a beta of -0.87. And then one final slide we'll look at. This simply looks at expected return and beta. So let's start at the bottom. We have a beta of -0.87 for collections. These are the 5 companies or 5 investments that this chapter follows. And you can see how the expected return and the required return increase consistently as the measured risk increases. Okay, so the greater the risk we bear, the greater the expected return and the greater the required return. In an efficient market, the expected return should equal the required return. So that's it for this section of the PowerPoint. If you have any questions, please post me a question on the discussion site or on my email. Thank you very much.